Well, I'm always concerned about the state of the U.S. economy, and the primary reason why I'm concerned about it is it's built on sand. And the reason why I say it's built on sand, it's built primarily on debt and asset bubbles and artificially produced interest rates. Now, I run a long-short portfolio, and I would be out of business if I was always short the market. What I'm primarily concerned about, and I've been concerned about this for a very long time, again, is that the construct of the economy is artificial, and that tends to lead to massive breaks. You just look at, we had a little virus that broke out in 2020, and the market completely fell apart until the Fed printed $6 trillion, and the Treasury handed it out to people in helicopter money. We had a crash of the economy in 2022, in case people forget about it, and it was over pretty much nothing. We had, April 2nd of 2025, and that caused little Liberation Day tariffs blew the economy up, and stocks lost 15% in just a matter of a few days. So the economy is very fragile. The markets are very fragile because they're built on three massive asset bubbles. You've got the debt bubble, you've got the real estate bubble, and you've got the equity bubble. So when you have that kind of tenuous situation, things tend to break. So right now, we have a Federal Reserve that they want to cut interest rates. In fact, they just started another round of cutting interest rates by 25 basis points. We have a member of the Fed, Stephen Moran. He wanted to cut rates by 50 basis points, and he wanted to do 3 in a row. So the next 3 consecutive meetings, 50 basis points, taking all the way down to by 200 basis points in the very near future. And you think about, wait a second. We have inflation, which was rising at 20%, around 20% per annum following COVID, which bankrupted the lower 3 or 4 quintiles of this nation. These are people who have no savings, less than $1,000 in the bank, living hand to mouth. They cannot afford insurance and taxes and food to buy a house. The home prices have priced out. The transaction market is frozen, and first-time home buyers have been priced out. And yet we're starting another round of interest rate hikes to blow these asset bubbles even higher. The labor market is giving signs of a recession right now, but the labor market is, in my opinion now, more of one that is supply constrained. And by that, I mean because of the immigration policies, which I am all for, but 1/2 of the GDP input is the labor force growth, the other half being productivity. And if you stop millions of people from coming across the country, thank God we've done it, illegally, and we don't know who you are, and that goes from 1 million or 2 a year to 0, you're going to have an economy that's constrained by that one input, which is called labor force growth. And then when you think about the tariffs and you think about inflation, we have anemic GDP growth that sits on top of asset bubbles. So am I a Cassandra saying the economy's crashing, get out now of your asset holdings? No, I'm not saying that. I'm saying it's a weak economy and a fragile economy, which is prone to huge declines in the equity market, which, by the way, we've avoided. We happen to be very long right now, but we're very cautious, and I'll tell you why. The big caveat here is that while the Fed is cutting short-term interest rates, it's the long-term interest rates that I'm most concerned about. They, being the Federal Reserve, does not directly control long-term interest rates. Well, who cares about that? Well, I do, because that's where mortgages are priced. That's where corporations borrow money at the long end of the yield curve. Student loans, auto loans, a lot of consumer debt. If you want to talk about home equity lines of credit, they're priced off the Fed funds rate. Credit cards, Fed funds rate. But a lot of debt is priced off the long end. The Fed is not controlling that right now because we're not doing any kind of, large QE. In fact, we're still in some kind of washed out QT program. So a weak economy, but prone to very big air pockets in the equity market. The overnight interbank lending rate has absolutely nothing to do in reality with the 10-year note, the benchmark rate, which is where mortgages are priced. And by cutting the overnight interbank lending rate by 25 basis points, in no way in my mind is able to produce more people entering into the labor force. So I don't think it's going to do anything for the economy. What it has done is now sent the asset bubble that we have now. I'm going to give people exactly the truth. So if you look at a price to sales ratio or a Shiller PE ratio, if you look at my favorite, the total market cap of equities as a percentage of GDP, which is now 220%. The average of that metric is around 90, that ratio. And now we're at 220. I mean, it's over the top, bubblicious. And we're going further in that direction because we're now saying to investors, well, you parked money in the money market fund because, you want to earn 4.5%, but now you're going to be earning probably over the next year closer to 3 or 2. So you need to get out of the money market and buy something out along the risk curve. Maybe buy some more houses if you can afford them and buy some more stocks. And setting this bubble into what I call it's an all-time record high housing bubble record equity bubble and an all-time high bond bubble. And we've never had three existing concurrently at the same time. And when they burst, it's going to be catastrophic. And why it's going to be different this time? Well, people could say, well, the bubbles have burst in the past. Why can't the Fed just lower interest rates again? And why can't the Treasury and the Fed join in that unholy union and monetize helicopter money? Why can't they do that? And I say, of course they will, and they can do it. But when the problem is that inflation and insolvency are your main issues, so you can't get inflation under control, the level of prices that bankrupt the middle class, they're leading them towards complete penury. And now you can't get to 2% inflation, which is, I call it asinine because inflation should be 0, but you can't even get to 2. And that's been the case for 54 months now. All you're doing is sending asset bubbles even higher and into more dangerous territory. So I don't expect this to end any differently than before. The Fed is going to do their Pavlovian response, cut interest rates, print money, Treasury's going to borrow trillions of dollars. But when inflation and insolvency are already your problem, doing more of the same to exacerbate that problem cannot be the solution. Where is it written in the Bible that, thou shalt not ever have an asset price decline? These people are all about power and, it's bread and circuses. This is what we're doing in this country and many other countries as well. So they have a tool. We don't have a gold-backed currency or a silver-backed currency any longer, like it says in our Constitution, Article 1, Section 10. We have to have a currency that's backed by, in specie, backed by a metal and not copper or tin or balsa wood, gold or silver. So they're going to do what they're going to do. And I don't expect the consequences to be any different this time around, except the fact that the mollification or the remediation that comes from blowing up the Fed's balance sheet is just not going to work. It's just going to send the long-term interest rates much higher, which I believe is going to cause the Federal Reserve to try to do something called interest rate control, which they were doing in Japan, where they just say, okay, for example, the benchmark 10-year note will never go above 5 point whatever percent or 6%. They'll pick a top. This is what I think is going to happen. The long end of the bond market is going to become unmoored. It's going to go above 5%. The stock market's going to melt down, and that's going to cause them to say, I promise to do whatever it takes, like Mario Draghi said. We will buy and print as many long-term U.S. treasuries as it takes to keep that rate from going higher. So they're going to keep rates low by creating a massive amount of inflation on top of the inflation that already exists. Now, we want to talk about the housing market. I know where I live here in Naples, Florida, it's already down between 10 and 15% in some of the country clubs that I haunt. So I think it's going to go lower. The home prices just got too expensive. They went up 100% in 1 year in Naples, Florida. So I don't expect them to go up. I expect them to continue to go down. But that's healthy. It is okay to have a recession. It is okay to have asset prices reconcile with metrics like income. The home price to income ratio has never been higher. That has to change. So house prices can stay flat while incomes catch up, or house prices can crash, which I think the latter is going to be the case. Same with stock prices. Total market cap of equities as a percentage of GDP, 220%. That has to come back to 100%. So you're going to need a 50% decline in asset prices, or you're going to have stocks stay where they are for a decade or so and have GDP rise. There's no way around that. I believe in the reversion to the mean. I believe it. Nature believes it is going to happen. How that happens is not knowable, but if you look at history, bubbles never really burst gracefully. They tend to crash and then overshoot to the downside. The underwriting standards have greatly improved since 2008. That's true. But let me just hasten to add, you mentioned FHA secure loans. So there was about $3 billion worth of FHA secure loans in 2007. There's now $40 billion worth. And those are 3.5% down and doesn't take 4% down on your house value. And all of a sudden, I might as well rent because I don't have to pay property taxes and maintenance, insurance on rent. And renting has never been more cheap as far as home. So home ownership is at the lowest affordability this country's ever seen. But I have to also add that even though we don't see the ninja loans and the liar loans that we saw before, we see a lot of loans with very little skin in the game. That's true. But what we have this time around is not only the home price to income ratio is much higher now than it was in 2007, but we see ownership of single family homes. In other words, investor ownership of single-family homes has gone through the roof. It depends on the data source. Between 20 and 30% of all single-family homes in this country are not lived in by the owner. They're either rented out or their investment properties. That's an extreme. If 1 in 4 homes can hit the market, not because people have to move, but just because they make the calculation, well, I'm up 100% on this home in the last few years, and the taxes and insurance are killing me, and the economy is entering a recession, and my renter is no longer paying me rent. I'm going to just sell the house. That's just a phone call away. And these listings could pop up on the market with alacrity and rapidity. So the housing market is very, very fragile. That's what banks own. They own a lot of these real estate related assets. And I predict the same thing that happened in 2007, 2008 is going to happen again. It might be to a slightly lesser degree, or it could even be worse. I don't know. I just know that the construct around the real estate market, and that includes commercial real estate, is extremely fragile and prone to collapse. And by collapse, I define collapse as anything bigger than 20, 25%. And you're seeing that in Florida already in some parts. And I don't see why it would spread throughout the whole nation.